I'll tell you which broker to use if you want to lose money even faster trading, which one to use the most. So this is joint work with Xing Huang and Philippe Jorion, and we have a equity paper that's similar. So this is kind of the option version of the paper, which is I'll tell you why it's kind of interesting. All right, so really kind of the big picture, what we're doing here is, of course, things have gone really commission-free over the last 5 years, and SEC has this quote: investors should be mindful of how their orders are handled, including the difference between free and no commissions. And the point the SEC is trying to make here is that some people may see no commissions and think that trading is free, but of course, trading might not be free depending on what your execution costs are. And so we kind of have this broad research question, which is what impacts the price execution of retail trades. All right. And so, equity trading, as we all know, has gone up a lot. We know about GME and all these other things that are going on, but this has actually also happened with retail option volume. So you can see here, there's a spike of before COVID till now of up to 250% above baseline, kind of over a couple of periods of time. More generally, kind of averages more up to 100%. So this is one way people identify retail trades, which I'll comment on a little bit as we go along. But retail option trading is about 4 billion contracts per year now. So total volume is about 10 billion option contracts per year. Retail trading is about 4 to 4.5 billion of that. And again, this is up 100 and 150% over time. All right, so why is it up so much? Well, first, commissions went to zero. And also brokerages have essentially been pushing options, especially firms like Robinhood, for example. And so we've seen this general growth in retail trading of options over time. And that's kind of the reason why. All right, so just to kind of review, if you're not familiar with kind of how marketable equity trades are executed, let me go over that really quickly because the option structure is similar but different in some key ways. So you, the retail investor, you pick a broker, so you guys can pick your favorite broker of choice. All right, 30 years ago, if we were doing this talk, I tell you that your trade would go to some exchange, NYSE, NASDAQ, etc., would be executed. But now your equity trade, I can promise you, if it's a marketable equity trade, is essentially going to be executed off exchange by Virtue, Citadel, etc. Actually, I was telling Dimitri, I'm actually at Citadel Securities in New York right now. I have a meeting after this with someone there to talk about some stuff. All right, and what they're going to do is they're going to execute off exchange because you have to pay a fee. All right, so if your trade would go to on exchange, you have to pay a liquidity fee, a taker fee, what they call it. And the wholesalers, because they know that they're trading with retail traders who are probably uninformed, they can make a lot of money by executing these retail trades off exchange. All right, and so what happens is retail, the Citadels of the world make a lot of money because they're executing these retail trades with uninformed people. They're going to pay some money to brokers in the form of payment for order flow for these trades. So essentially, they're going to pay the brokers to route these trades to them. And they're also going to provide some price improvement to retail investors. All right, so essentially, there's a pie. The wholesalers are going to take their cut of the pie. And then the rest of the pie gets split between a payment to the broker and better execution for the broker's customers. And obviously, you can imagine this is a conflict of interest because the broker wants to make as much money as possible. And to do so, that will probably cost the retail investor something. That's the potential conflict that people talk about. All right, so this is for equity trades. All right, so option trades, you can see the bubbles are going to look similar, but actually how trades are executed is much different. All right, so off-exchange execution of option trades is not allowed. And the reason it's not allowed is because all option trades need a clearinghouse because, of course, you can create and destroy options contracts at any time. And those clearinghouses are at exchanges. All right, so by default here, no marketable option contract trade can be off exchange. So brokers are still going to route it to these wholesalers, all right, which you can see the names of the wholesalers have changed slightly different, Citadel, G1X, Wolverine, etc. But now these wholesalers have to route your trade to an exchange for it to be executed. And when your trade gets routed to an exchange, it opens the trade to competition, right? Because of course there's lots of people interacting on the exchanges. Trades are anonymized, so there is no broker name attached to the trade when it goes to the exchange. In fact, it'll just be labeled customer. And all trades must be treated equally. So on public exchanges, no one customer can be treated differently than another customer. All right, so in essence, you've essentially taken the wholesaler, now made them take it to an exchange where, in theory, trades are anonymized, they should be treated equally, and it opens them to competition. At the same time, as we're going to talk about later, the exchanges, this routing to exchanges still allows the wholesaler to internalize, which means essentially execute the trade against their own order book. All right, so they have this ability to internalize trades, which means they still have the ability to make a lot of money off these retail trades, which means they're still going to pay brokers for the trades, and they're still going to offer potential price improvement to customers. All right, so kind of the bubbles here have stayed the same, the players have stayed the same, but the way the option trades have to be executed is essentially completely different for options than is for equities, in the sense that all retail trades will be executed on exchange for options, versus all retail equity trades are essentially executed off exchange. All right. And so the question in this paper is kind of what impacts retail option price execution, given that they have to go to exchanges and given that they're anonymous. All right. So should pricing across brokers vary? All right. So there's lots of reasons that it shouldn't vary, right? So of course, if a trade is anonymized when it goes through exchange, that kind of makes it hard to give differential pricing if nobody knows who you are. Competition would offset any price differences. Brokers have best execution duties. They have to give you the best price possible. And again, myself and co-authors have papers that show that, payment for order flow doesn't really seem to impact equity execution. Of course, most importantly is Robinhood tells you it shouldn't matter for PFOF, right? So Robinhood believes the receipt of payment in the form of a portion of the spread paid by Citadel, for example, does not interfere with Robinhood's pursuit of best execution or price improvement on customer orders. So Robinhood basically explicitly states that PFOP's not going to matter for these trades. On the other hand, there's lots of reasons you might expect there's differences, right? So exchanges have rules that facilitate internalization by wholesalers. Toxicity could be different across different brokers. Toxicity here meaning the profitability of Robinhood trades may be different from, say, TD trades or Vanguard trades. And option PFOP, most importantly, is way above equity PFOP. So just to show you here, the brown or tan bars or whatever color you want to call it, on the right of the bars is much bigger than the gray colors which brokers get for their equity trades. So option trades provides a lot more profitability for these brokers than does equity trading. In fact, if you look at Robinhood, their option PFOP or payment for order flow they receive from the wholesalers is about 30% of their overall revenue of the firm, right? So option PFOP is a huge amount for these particular brokers. All right. So the question is what impacts execution of these retail option trades? So I've kind of laid things out. Yes, conflicts of interest driven by PFOP. Other things drive execution, or no, exchange and anonymity and duty of best execution gets all brokers the same price. So the challenges that we typically have is execution price is not available till trades happen, right? You just get quoted a spread. All trades in the market would be endogenous when you look at our data sets. And current data sets have no information on anybody who handles your trade, doesn't have broker information, wholesaler information, etc. It doesn't even tell you the sign of the trade. You don't know if it's retail or not. You don't know if it's a buy or sell, etc. All right, so we're going to come up with a novel way to fix this problem that we have in these databases. And our novel way is we're just going to lose a bunch of money by opening 6 brokerage accounts and placing 7,000 parallel market orders over a 3.5-month period. So basically, we're going to generate our own database where we know everything from the broker and if it's a buy or sell, to the wholesaler that's going to receive our trade, to the exchange that our trade is going to be routed to, obviously how it's handled on that exchange, who the specialist is at an exchange, and of course we're going to know our price execution. So we're going to essentially have from birth to death everybody that handles our trade and what kind of pricing we get on our trades. All right, so preview of our results here. I'm gonna try to keep this at 60 minutes because everybody's time is important. Does price execution vary across brokers? Yes, it's going to vary a lot. And in fact, the price execution you get on option trades across brokers is even bigger than what you see in equities. So even though option trades go to exchanges, they actually have more price variation across brokers than equity trades, which can be directly internalized by wholesalers. All right, so what primarily creates differential pricing? So venues are going to treat brokers systematically different. How can anonymous trades get different pricing? I'm going to show you how venues, or venues here, by the way, just another term for wholesalers, can influence the pricing of your trades that when they go to the exchange. Why do wholesalers give differential pricing? I'm going to show you that it's basically 100% related to how much PFOP they have to pay the brokers for the trade. So the more that the wholesalers have to pay the broker for PFOP, the much lower execution quality that the customers are going to get. All right. And obviously, there's some important implications for investor behavior, disclosure, and market design, which I'll touch on as we go along. So I'm going to pause here just to see if there's any questions anyone has, or what's their shout out before I get into some details.
Just a quick clarifying question. So you guys will submit market orders, not limit orders, right?
That's correct. So limit orders based on equities are essentially just going to get it executed at your limit price across all brokers. For equity limit, so these are non-marketable limit trades that just go to the order book. For equities, pretty much all of them executed at the same time, and they always execute the limit price. So we haven't done options, but that would be my expectations for options. So these are marketable, that's correct.
And then similar to equities, it's just in addition to like simulating those trades, you need to like contact the brokers and knock on their door to get actual executions and all of this stuff, right? Because you will only observe like, hey, this is the trade, this is the exchange that got executed, but you need much more, and then you follow the same kind of route.
That's correct. Yeah. So to get the wholesaler, you have to request data from the broker to get the wholesaler information from them, which I can talk about if you guys want. But yeah, you can request something called Form 606B1 from your broker, and that form, over the last 6 months, they have to tell you for every individual trade which wholesaler they routed your trade to by SEC rule. I will tell you that pretty much every broker is violating that rule in one way or another. But eventually we get the data. So for example, they're supposed to give you an XML file within 5 business days of your request. E-Trade took 4 months, and they FedEx ground a 397-page document, hard copy, which they think holds. They know who we are at this point, and they make our lives difficult. So, at every industry conference, apparently the brokers complain about me. So I'm infamous, which I guess I'm proud of. By the way, we have checked for other accounts not in my name or Philippe's name to see whether or not get similar execution. They do get similar execution. So they're not doing anything funky with our accounts, just making that report difficult for us to get. So,
Christopher, I have a quick question.
Sure.
Anya Kapolsky from University of Puget Sound over here. You report different brokers. You have Ameritrade, I think, Fidelity. I didn't see interactive brokers. Don't they have a big option volume?
So we can talk about them. I mean, Interactive Broker Pro is generally seen as kind of a non-retail client. So if you actually look at Interactive Broker Pro, none of the wholesalers take their trades. So they actually have their own trading platform. They're actually market makers at all the exchanges. So they actually directly route their trades to exchange because the wholesalers don't want to handle them. So for example, Research Affiliates, which is a large active ETF and active mutual fund manager, actually uses IBKR Pro for their testing platform. So that gives you a kind of an idea of the average Interactive Broker Pro client. But I do have trades for them that we did afterwards. And if we have time, I can talk about them if you want, how they handle those. But again, we didn't include them in here because they don't use the wholesalers. They have to directly route. By the way, the retail, it actually says on the retail brokers actually guarantee wholesalers these are retail trades that they're sending. So they actually promise the wholesalers their retail trades. Whether, I don't know how they police that, but that's what they promise. All right. But again, Robinhood says lots of things in there. Robinhood has a religious belief about PFOP, which I'll show you later when it comes to their "we believe" statement. All right. So, so as noted by the question, we're going to trade at 6 brokerage accounts. All right. I'm going to mostly just focus on the PFOP thing. There's differential fees. There's lots of things related to fees about whether or not you could trade SPX or SPXW and all that kind of stuff. For the wholesalers, which is we're interested in price execution, they don't care what the fee is. So I'm just going to focus on the PFOP differences. All right, so you can see that essentially all of our brokerage accounts are over about the same period of time. It took a little longer to get Schwab going. We added Vanguard on a dare from a particular wholesaler whose office I might be sitting in right now. So we added that one later, and I'll show you why, or you can see here why. So Vanguard has literally 0 PFOP on their trades, all right? Fidelity technically says they have no PFOP, but then they take fees back from the wholesaler. So whatever fees their trades generate get rebated back to them through the wholesaler. That's just PFOF of a different name. If you want to think of it that way, Vanguard doesn't get any of their fees or any payment at all. Fidelity claims they only get their fees back. You can see TD and E-Trade and TD have basically the same PFOP. And then you can see Schwab has 46 cents of PFOP. So we have a very big differential in terms of the amount of PFOP that the brokers receive. Please note, we didn't just stop randomly trading E-Trade, and Schwab. TD was bought by Schwab in 2020, and finally my TD account was converted into a Schwab account and on May 10th, and so that's why we stopped trading at TD. All right, one other thing to note is TD and Schwab are owned by the same firm, obviously, so they have the exact same PFOP arrangements, so they don't get in trouble with the SEC. We have been told independently, randomly by industry people that the PFOP agreement set for TD trades because that's the highest volume, and then Schwab just basically replicates, and so Schwab might not be an independent observation, and so we'll get back to that in a minute. Okay, so 6 brokers, totally different PFOP across brokers. We're going to trade 7,000 trades over 3.5 months of time. We're still trading now. We haven't really looked at execution except for IBKR Pro, and Robinhood looks the same. I know that for sure. We got in a little fight with Robinhood, which I can talk about if we have time. We're going to trade 18 symbols. These are very popular symbols that represent half of market volume. So about half of market volume. Most of our trades are 1 contract call options near the money. Nearest weekly expiration, not doing day 0. We didn't do day 0 for operational risk reasons. So if our program crashed and we're holding options on day 0, then we have to take delivery, and we didn't want to risk that. So on Friday, which would be the day of expiration, we just roll over to the next week. You can see in parentheses, if you look in the opera database, this is the percentage these trades represent of all trades. So in all cases, this is the majority of trades that are represented in the database. We did do robustness where we did puts instead of calls. Execution looks exactly the same. We did 6 contract trades instead of 1 contract trades. Things look exactly the same if you look at 6 contract trades. Yeah, we did do a lot of big trades because obviously this is our own personal money we're trading, and so it got kind of expensive to do more. So again, some caveats that our sample may not represent the other 50% of very illiquid options, etc. And those caveats apply. But I think generally speaking, this is probably pretty applicable to most retail trades. One thing that we did do, which I'm going to talk a little bit more later, is we did try to pick symbols where not all wholesalers could route to an exchange where they are the specialists, right? So for example, if you look at NVIDIA here, if the broker sent our trade to Citadel, G1X, or Morgan Stanley, the wholesaler, those firms don't have a specialist on any of the exchanges they can route the trade to. Versus Wolverine, they do. Versus Wolverine, IMC Dash do not have any specialists they could route to. So the idea here was we could do a little control whether or not the ability to route to your own specialist or not, whether or not that influenced pricing. Again, you can see the tickers we have here are all very popular, like Apple, QQQ, SPY itself, I think is 14% of volume. So again, these are all very popular symbols that are big volume tickers. Last thing, just in terms of trading, I think if I were to sum all of this up, we just randomize everything. So the order of the symbols every day is randomized. We trade the brokers in sequence rather than trying to do all 6 at the same time in case latency is a little bit different. So we just trade broker 1, 2, 3, 4, 5, 6, and then each time we trade, the order of the brokers is random. So Fidelity is first, 16% of the time, second 16% of the time, etc. I'm going to show you broker order effects is much smaller than the broker effect. We buy and sell. We sell after 5 minutes. They're evenly spaced over the day. We do 1 trade and then 10 minutes later do another buy trade. Again, time of the day, symbol order, everything was randomized. And then we're going to match our trades to Opera to get the execution bid and ask. We use API, submit time, bid and ask, doesn't matter. What exchange, execution method, etc. So we, again, have full birth to death on all of our trades. All right. All right, last thing, I think probably most of you are familiar on measuring price improvement. We're going to measure it 3 ways. So the first way, we're going to measure it in just dollar amount, which is, so for example, in a buy, we see how much under the offer we are in terms of dollar amount, right? So obviously a buy, worst case scenario, you get NBO. We're going to see if we're NBO or under. All right, we can also do that as percentage of spread, which is going to be the one I'm going to focus on mostly. All right, so this is just dollar amount divided by NBBO spread. And then we can also do round trip trade costs. So this is our actual return, sell price minus buy over buy. And then this last term here just gets rid of market movement during the 5 minutes we held the option, just to get rid of noise. So sell minus buy over buy using the midpoints, right? Because we're trading the same trades at the same time across all brokers, again, all three of these are basically going to give you the same answer. All right, so before I get into execution, any questions on the experiment design, measuring price improvement? Am I talking too fast? I'm in New York. I have to talk fast. It's a rule here.
And
right.
NBO, like, who provided the Opera data? So because I presume with the Opera data, this is where you see NBBOs, right? So
yeah, so we purchased Opera data, and Opera from CBOE.
Okay.
Yeah. You know, live vol, we're getting the live vol data where we can actually see the stream of trades. I'll actually show you one interesting thing that's happening with our trades with live vol, but we're relying on CBOE to give us the NBBO for execution time. So we did download the NBBO using the API right before we traded. So you can think of that as a proxy for submit time NBBO. And that would give you the same price improvement that I'm going to show you here on the next slide. All right, so you can see one thing I should know here, there's no sub-penny price improvement in options market. So everything's full cent price improvement. So equities, you can have sub-penny up to a 1/10,000th of a penny. Here it's all full penny increments of price improvement. All right, so midpoint is pretty much the best I think you could expect economically to get. If you got better than midpoint pricing consistently, you'd get paid to trade. NBBO is in theory the worst possible pricing you can get. And so if you just look at the percentage of trades that get price improvement, you can see it varies widely. So 72% of our Vanguard trades get price improvement versus only 14% of our Robinhood trades. And again, these are in order here. So you can see Fidelity second best, Schwab, TD, E-Trade, et cetera. If you look at percent of NBBO, so again, this is probably a better measure of price improvement because people can just do a little price improvement on trades and try to look good. You can see that Vanguard essentially we're trading at midpoint. So price improvement's 51% of spread. So 50% of spread is, you're trading for free. You can see it varies all the way down to 7.2% for Robinhood. If you do these pairwise, so if you just look at Vanguard versus Fidelity, et cetera, they're all statistically significant except for these two. You can see that TD and E-Trade look very similar. And again, if you look at cents, you can see the same kind of distribution. And if you look at round trip trade costs, you can see basically Vanguard trading is free, and Robinhood's about 7% of our option cost is eaten up by round trip transaction costs. Our average trade price here is a little bit over $1. It really doesn't matter. We looked at high price versus low price. The answer here would be the same in terms of the difference between the brokers. But obviously options, you have different options you can pick for symbols. And so, the magnitude here in absolute terms will depend on the price. So if it's $2, you can divide all these by 2. But again, the order would be the same and the price would be the same, right? So again, we're getting huge differences. So just I'll talk about equities different later on, but the difference for equities here is actually much smaller than we see here for option trades. All right, so Vanguard's the best, Robinhood's the worst. Probably if I tell you that doesn't surprise you that much. All right, so there's a couple of reasons we have lots of reasons we get different pricing. All right, so one reason we get different pricing is brokers are using different wholesalers, right? So Vanguard, for example, only uses 3 wholesalers. Robinhood uses 5. E-Trade doesn't use Morgan Stanley as a wholesaler because they're owned by Morgan Stanley, so they don't want a conflict of interest. All right, so again, we're going to use our 606B1 request to figure out which wholesalers are getting our trades. And then look at our trades. All right, so this is just basically showing you this is not because of which venues or wholesalers are being used by brokers. All right, so this is Vanguard versus Robinhood. So if we look at our 2 trades at the same time, if both of our trades go to the same wholesaler, so say both of our trades, our Robinhood trade and our Vanguard trade, at the same time both go to Citadel, for example, you can see the difference here between our price improvements about 40% of spread. If they go to different venues, so one goes to Citadel, one goes to Wolverine, you can see the difference is like 46%. All right, so the point of this is not, Vanguard's using different wholesalers than Robinhood. The point is essentially wholesalers are systematically discriminating against one broker versus the other broker. All right, so it's really coming down to the wholesalers are providing differential pricing for different brokers, is what we're trying to show here. All right, so how are they creating differential pricing, right? Trades are anonymous. How you get anonymous differences on trades on exchanges? All right, well, there's going to be two ways that your trade can be executed on an options exchange, right? So one is going to be auto execution, which is essentially you just trade against the order book. And another one is you can go through what's called a price improvement auction. And I'll talk about more of these in a minute. All right, so the sources of the execution differences, there's two. So one is extensive margin. So how many auto X trades are happening versus auction. And the intensive margin, how much price improvement you're getting in auto X trades versus how much you're getting in auction trades. All right, so let me talk a little bit about how executions work here when the wholesaler routes your trade. All right, so again, the wholesaler gets its trade from the broker. All right, so option number one, pun intended, is they can route your trade to an exchange as an auto X trade. All right, option number two, as I mentioned, is they can route your trade to an exchange as a price improvement auction mechanism. All right, so the first thing you can see here is that the wholesaler receives 25 cents or more if they route your trade to an exchange as an auto X trade, right? So it's 25 cents minimum. And then if they have like tier volume that they hit or whatever, they can get more than 25 cents versus the wholesaler only gets 14 cents if they route the trade as a price improvement auction. All right. If they route the trade as an auto execution trade, generally speaking, you're going to see there's not a lot of price improvement. I'll show you that on the next one, right? They're just going to execute against the order book. The market maker for this trade is probably going to be the specialist, which they're now called designated market maker at the exchange. So they have privileges in terms of anything 5 or less contracts they can just take and internalize. There's some exceptions to that, but you can presume whatever exchange our trade goes to for an auto X trade is the designated market maker, the specialist, is probably handling the trade. And the way that the wholesaler would internalize the trade is the wholesaler would route the trade to an exchange where its affiliated market maker is essentially the DMM, right? So again, Citadel routes the trade to, say, Miami, right? And they're the specialist at Miami, so they take the trade, route it to Miami where they're the DMM, and then they internalize the trade because their DMM takes the trade, right? So that's how they would internalize the trade against their own order book, all right? For price improvement auctions, things are quite a bit different, all right? So if your trade goes through a price improvement auction, all right, so the first thing that happens is the wholesaler is going to initiate an auction. There's going to be a bidding prices for 100 milliseconds. And then whoever offers the most price improvement is going to win the auction, right? So again, it's a typical auction. This is probably not surprising to anybody. All right, so what happens is when the auction is started, the wholesaler essentially specifies a starting amount of price improvement, which, by the way, can be 0 for any spread more than 1 cent. All right, and it's going to route the trade as what's called a paired trade. So like, say we're buying a call option, it's going to route the writing of the same option together. So both trades go together. The reason this is done is because the auctions have to guarantee execution, right? So if we're buying, someone has to be writing the option, right? For the option to clear. And so in these auctions, if no one else comes bids in the auction, the wholesaler is basically guaranteeing execution by routing the trade together. All right, so at that point, the bidding process starts, right? Anybody can bid in the auction. The wholesaler affiliated market maker or unaffiliated market makers, anybody can bid in the auction. And again, what happens at the end, if the wholesaler wins, they have to pay a 5-cent fee because they win. If someone else came in and won the auction, they have to pay 50 cents. They call this the responder fee. All right. So again, if someone else comes in and wins the auction, they have to pay a bigger fee than the wholesaler. So again, auction, both trades go together. There's a starting price, which is known by, I should note, the starting price of the auction is known by the market, right? The wholesaler can specify a maximum amount of price improvement they're willing to provide. It goes through the bidding process. If someone bids more than the maximum amount of price improvement the wholesaler is going to give, then they win, right? And then pay the 50-cent fee. If nobody outbids the wholesaler, then the wholesaler gets to keep the trade and pays 5 cents. All right, so the market maker here in this particular case is always going to be the wholesaler. So it doesn't matter who the DMM is at the exchange. It's only going to be the wholesaler that's always going to be the market maker on these because they're guaranteeing the execution. All right, and the way you internalize is basically the wholesaler routes the trade to an exchange as an auction, and the wholesaler wins the trade, which means they take the other side of the trade and can internalize. All right. So I know I went over that quick, so I'm going to stop here and see if there's any questions quick on how those things work.
Just a quick clarifying question. So the way the orders are routed is just similar to the equities, where a certain share get routed to Citadel, and then another fixed share will be routed to Sipsvahana and so on. And then once in a while, Robinhood will revise kind of the share that it will send. But it's basically like on the Rolex, like every third order will be sent to Citadel, right? So similar to equities.
Yes, that's correct. So some brokers will do different things. So Robinhood actually does like a selective method where for particular symbols, Citadel might get more or Wolverine might get more. And then, but most brokers, they do what's called proportional. They just take a slice of their order flow and send it off. Yeah. So the brokers route options exactly how they route their equity trades, I guess is the short answer. All right. Okay. So if you kind of look here at benefits, all right, so if you're the wholesaler, right, pretty much you'd prefer to do an auto X trade if you can, right, because you get a higher fee, right, so that's more money in your pocket. You can see here you're going to give you're going to get much higher revenue because you're offering much lower price improvements, right, and of course, as a retail trader, you'd like more auctions because they're more competitive, right, so people can outbid the wholesaler or make the wholesaler pay more price improvements, so these are the ways that you would prefer, all right, on these particular trades. All right, so first let's see what the wholesalers are doing in terms of weight. So these are 6 brokers. This is the amount of price improvement that we're getting on average. All right, and so you can see here, if we look at Vanguard, about 76% of all of our trades are being routed to an exchange as an auction. And you can see at the other end of the spectrum, only 25% of our Robinhood trades are being routed to the exchange as auctions. All right, so the first way that these wholesalers are creating differential pricing across brokers is they're systematically using a different percentage of auctions, which is the primary way you get price improvement, right? Now, if you're wondering why they would offer price improvement more to Vanguard, please remember there's a bunch of wholesalers competing against each other for Vanguard's trades. This is kind of Dimitri's question, right? So there's some competition, right? So Citadel just can't give Vanguard 0 price improvement because Wolverine might give them a lot of price improvement. So these wholesalers have to compete against each other to keep Vanguard's orders flowing to them. All right, but you can see method number 1 is, again, you can see there's a huge difference between the percentage of trades that are going through auctions that we see here. All right, second thing is if we look at our within method pricing, right? So again, we have 25% of Vanguard's orders are going price in auto X trade versus 75% for Robinhood. And then we have the opposite for the auctions. So then the question becomes, once routed, we would expect that the trades would be getting equal pricing, right? So of course, you take an auction trade and you route to the exchange, nobody knows which broker the auction is for. They just see an auction started. And if you route an auto X to the exchange, nobody knows who the broker is. So you'd imagine that within the execution method, the execution will look the same. All right. And what we see here is that is totally not the case. All right. So if we look at auto X trades, so again, the mean price improvement is only 5% because they usually just go against the order book and get no price improvements. You can actually see there's quite a bit of differential pricing. So Vanguard gets 12% price improvement on its auto X trades versus Robinhood gets 2%. And if you look at auctions, you can see the huge differential in price improvement in auction trades. 67% for Vanguard trades versus only about 25% for Robinhood trades. All right, so not only are the brokers creating differential pricing through the use of auctions, but they're also doing it by getting differential pricing within the execution method that they're picking, which is actually quite surprising given that the trades are going anonymous to the exchange. All right. All right. So how do they actually do this on auto X trades? This was kind of one of our big mysteries. And so let me take a look at this one to see how they do it. Because of course, auto X trades are completely anonymous. They're just posted against the order book. And so finally we figured out this mystery is that essentially they convert. So step 1 is they convert, this is one of our trades. They basically convert one of our trades from a market order to a limit order. So this is our trade here that's being posted on ARCA. You can see customer bid. So they took our market order, turned it into a limit order. They posted it within the current spread, right? So you can see the prior bid was 36. They post this at 41. All right, they hope somebody else interacts with it or they interact with it themselves, right? So our trade gets executed at the 41 cents. And then they do this for more brokers than others, right? So they do this for Vanguard more than they do for Robinhood. Right. So again, this is the way that they create differential pricing is by essentially manipulating I should probably not use manipulate, but they alter the order book so that our trades on the inside and then you make sure it gets executed. All right. Auction trades are easier, right? So they directly set the starting price. So it's a little bit easier to understand how they get differential pricing on those. All right, so just to show you kind of overall our differences that we get, all right, so you can see that about 40% of our differential pricing is based on the execution method, all right, 50% is based on the auction method, and 10% is based on price differences in the AutoX method. All right, so you can see about 40% is based on the execution method, and 60% is coming from differential pricing within the execution method. All right, and so I'll pause here for questions if people have questions. All right, no questions.
Well, if I understand it correctly, just to summarize, right? So they will price improve in the auctions. So that's kind of the major channel, but they also manage to price improve through the limit order book, even though it just kind of very tricky.
Yeah, it's a bit tricky. So it's actually so one of the things we don't know is like within Vanguard why they do, like if you just look within Vanguard, like how they pick the 75% they do as auctions and how they pick the 25% they do as AutoX, and like why they choose certain AutoX ones to do this price improvement on versus using an auction. I think that part is a bit of a mystery to us on why they do those things. So we just assume like each trade they have a way that they can maximize profits, and for whatever reason some trades it's better to do one versus the other, and that's what they do. But yeah, that's correct. Yeah.
And my also reading, like the main message of this is just there is cross-subsidization. So some trades like go in the auction, they're likely to receive price improvement, and for some random reason other trades don't go in the auction, they're less likely to receive price improvement. So some trades essentially get screwed, and some trades get like, well, I mean, some favorable trade, not favorable treatment, but get substantial price improvement.
Yes, so I think that they definitely cross-subsidize a lot on the trade. So I think, you know, what we see is very consistent pricing. So for example, if I were to present this whole thing using, say, SPY trades only, it would look very similar to what I just presented, right? Or if I just picked any other ticker. My assumption is that wholesalers basically have like a knob they use, like we're going to provide this broker XYZ price improvement, and they basically, in some sense, just systematically apply that to all the trades that go through that broker. And if we have time, I can show you that if we compare it to IBKR a little bit later on.
Chris, I have a quick question. So for the auto exec trades, what's the incentive of Vanguard for trying so hard to do the price improvement? Like why are they trying so hard to do all those conversion compared to the other platform?
You mean the whole, so the wholesaler is the one doing the conversion, or you are asking why does Vanguard want such good execution, I guess is the question. Yes. I'm going to be honest with you, that's a bit of a mystery. You know, not to get to the punchline, but you know, Vanguard chooses not to take payment for order flow, which I've already told you is going to be the most important thing. Why they choose not to take payment for order flow on their trades, I don't know. It could be marketing, it could be like firm philosophy. You know, obviously Vogel had a very firm philosophy on keeping things, you know, transparent. You know, Robinhood probably takes a lot of PFOF because they need it for their firm to survive. So, you know, so those things we don't know. In fact, you know, I'm here today maybe to get a little insight into why certain firms try to charge more PFOF than others. I don't know. All I do know is that the wholesalers are going to try very hard to get good pricing for Vanguard to get their trades, because obviously they don't have to pay anything to obtain them. So they're money makers for them, right? So that's why they give so much good price improvement, because Citadel wants to keep those Vanguard trades coming because they don't have to pay Vanguard anything to obtain the trade. And that's why they get such good execution. I think, was there something in the chat, or I guess I don't have to pay attention to the chat.
Yes, Pedro was asking, well, just commenting that this only applies to market orders or marketable limit orders. And then he refers to Rule 606 and says that more than 74% of the orders on Vanguard are non-marketable orders. So, sorry.
Yeah, no, that's fine. Yeah. I mean, Vanguard is not, you know, I don't think a lot of people are using Vanguard as an active trading platform, right? You know, if you look at Robinhood 606, you know, their marketable limit orders are huge, right? So, you know, I don't think the point of the paper is to claim that Vanguard is the place everyone does marketable orders. I think it's more, what kind of execution is Vanguard getting on their orders versus somebody else if you were to trade the same trade. So, okay. Yeah, like I said, I added Vanguard on a dare. So Fidelity was getting really good pricing, and I showed my results to a large wholesaler who said that, well, if I took away the Fidelity dot, then it's not clear what PFOF is going to do. And then so I was like, okay, well, I have Vanguard because they have even less PFOF than Fidelity. And I'll show you the line here in a minute. I think the line will speak for itself. So,
and also like a quick last question, how this will compare to your other papers, the ranking of the brokers versus like how they execute stock trades?
Yeah, so they're actually like TD, for example, is our best equity broker, and they're one of our worst option brokers. So they're not huge. I mean, Fidelity is pretty good on both. So some of them, and Robinhood's pretty bad. So it's fairly correlated, but it's not 100% for sure. All right, let's see. So I could talk a lot about PFOP. Sometimes a graph is worth more than 5 minutes of presentation time. So I'm just going to show you guys a graph, and then you can like let your eyes tell you the story. So this is the graph where this is our price improvement on the y-axis, and this is the amount of PFOP reported on their Form 606 on the x-axis, and this is the line, right? So Vanguard has the best execution and no PFOP. Robinhood has the worst execution and lots of PFOP. So for example, Robinhood's minimum amount of PFOP for a 1 cent spread trade would be 60% of spread, just to give you some idea of the amount of PFOP they're taking. E-Trade and TD have exactly the same amount of PFOP, and you can see their execution dots are on top of each other. The only one that's not on the line is Schwab. And again, we've been told that Schwab's is not independent because it's tied to TD. Whether or not that's true or not, I don't know. By the way, the correlation here is minus 0.91 to show you the strength of the correlation. So it's minus 9.9. If you took Schwab away, by the way, if what we're told is true, then it's minus 0.997. So pretty much it's just a straight line on PFOP. And if you look within execution method, you can see that, again, the way they're getting this pricing is this is PFOP, and then this is the price improvement within auctions, and this is the price improvement within AutoX trades, and you can see it again. It tells you the same story. All right, so the bottom line is, we don't find things like order imbalance matter. We don't find any delta, gamma, buy, sell. Almost nothing matters for pricing except which broker fixed effect we put in. That explains almost all the variation that we can explain in our pricing. All right, so clearly the driver here seems to be payment for order flow. All right, so I have about 15 minutes to go. So let me cover a few things to talk about, and then if I have time, I think there's some interest in seeing IBKR because they don't use a wholesaler, so maybe I can talk a little bit about that in our time. So before I go through, because these are kind of more discussion points, any questions on the experiment or the results? Or so again, the idea here was to see whether or not anonymous trades got the same pricing, because we don't see that for equity trades. Obviously, we don't get the same pricing. We don't get the same pricing because they're able to manipulate how things are executed on exchange, and then the economic reason seems to be PFOP. All right, so let me just compare this to equity. So Dimitri asked about equity trades. So please note, I just have brokers 1 through 6 in both papers. We had 6 brokers. The order is not the same, which is why I just ordered them from best to worst. All right, so obviously, we just went over option trades. So I'm just going to stick to kind of the middle here with percent of NBBO. All right, so you can see here the min-max difference between our option trades about 44% of NBBO. If you look over here on the equity side, you can see the difference is about 28%. So most of this is being driven by broker number 6, which is Robinhood here. As this is not Robinhood. Robinhood was actually this broker in our other paper. Robinhood is just so much worse than the other brokers, which is really driving the result. But again, you can see there's quite a bit of difference here in options relative to equities, which is quite surprising. Of course, the other thing you know here is round trip trading costs are much higher for options. This is not surprising to this group, right? They have a lot of leverage compared to equity. And so we have much larger option pricing here, which is not surprising. All right. So if you look at our graphs of PFOF versus pricing, so this is the option graph I just showed you. All right. This time, instead of using percent, I use cents. You can see it again as the same graph. If you use cents or if you use percent of spread. If you did the same thing for equities, this is from our equity paper. You can see that it's flat, right? So in our equity paper, we really didn't find any real relation between price execution and PFOF. Obviously, the options market looks very, very different than that. All right. And really kind of what we concluded from the equity paper was that a lot of the differential pricing across these brokers is probably driven by toxicity of order flow. All right. So what does that mean? So basically it means that if you look at, say, TD, all right, TD's order flow is very balanced, right? There's a lot of people buying, a lot of people selling. They're trading all sorts of different symbols, right? So it's easy for a wholesaler to handle that flow. You know, so obviously for a wholesaler, the best possible thing is that I buy something and then you sell something at the same time. They cross it, they capture some of the spread, and they have no inventory risk. All right, we were told on the other paper that Robinhood, for example, was the opposite. They were, you know, all Robinhood traders traded the same stock in the same direction, and it made it harder for wholesalers to make money. All right, and so just to show you kind of what we found for equities was, you know, the broker fixed effect was about 15%. So if we did a regression of our price improvement on each trade on as the dependent variable, the broker fixed effects was about 15% R squared. If we looked at order and balance in the market at the moment we placed our trade, that would explain all by itself 10%. So it's almost as much as the broker fixed effect. And so if you put them together, you know, essentially that was 25% R squared, right? So if these brokers did have different toxicity, based on the fact that order and balance seem to matter a lot in the market, okay, well, if this is a proxy also for toxicity, then it would make sense, you know, that's the driving factor behind differential pricing. If we go to the options market, you can see our broker fixed effect almost has the same explanatory factor, about 15, 16%. But in this particular case, if you include order and balance either in the same contract or across the same symbol, within the minute we place our trade, you can see it has no explanatory effect at all on our trades, right? And so it seems that basically toxicity doesn't seem to matter as much as brokers. There's some other evidence from other papers that say the same. And so really that kind of ends up being maybe the difference here. So if you look at the options markets, right? So toxicity is low, PFOF is high relative to equities. And so PFOF dominates the economics. On the equity side of the house, right? PFOF is relatively small, toxicity differences are relatively high. And it seems toxicity might be driving the differential pricing that we see for that market, right? So you have these two different factors, and you know, in one market versus the other, PFOF dominates one, and then toxicity dominates the other, which is why we might be getting different results across papers. All right, the second thing is there's been a lot of talk about adding auctions, excuse me, to the equity market. So the SEC, which I don't know what's going to happen to the SEC. That's fine. They want to create this auction for equities, right? So basically, they model this proposal for the equity market so that match the options market, right? And so we want to really look at the auctions that are happening in the options market, because this is the way that they are supposed to create competition, right? But what you can see here is they didn't really create a lot of competition, right? So this is different spread buckets. So this is 1 cent spread, 2 or 3 cent spreads, 4 or 5 cent spreads, 6, 10 cent spreads, or 10 cent spreads, right? So, you know, again, these are anonymous trades, right? So, you know, and you can see there's huge differences in pricing across all these different spread buckets for these trades, even though they're anonymous, right? So, you know, if we go to the extreme here, if you look at Robinhood at say, you know, 4 or 5 cent spread, they're basically getting 15% price improvement on their auctions. Vanguard's getting almost 60%, right? So they're getting 4 times more price improvement as spread on these auction trades, right? So the implication being here that the auctions don't really seem to be super competitive, right? If they were competitive, then we'd expect everybody to get very similar pricing on these auctions, because again, everybody's anonymous. Nobody knows if it's a Robinhood or Vanguard trade. And the reason they're not very similar means that the starting price must be a very strong anchor, right? It must be a very strong anchor. Oh, I got a thumbs up from that on my Mac. All right. So in other words, you know, Vanguard auctions have a high starting price. Robinhood have a low starting price, and people aren't taking the Robinhood auction and bidding it up to meet the Vanguard auction. All right. So one reason that's been hypothesized is I told you that there's a 45 cent difference between The responder fee, if if a non-wholesaler market maker wins the auction, is 50 cents versus 5 cents for the wholesaler. So there's been some research that says, well, it's that 45-cent difference that's causing auctions not to be competitive. All right. Well, if you look at Robinhood, so this is Robinhood, and then you add the 45-cent fee on top, right? So this would be the friction from that fee difference. You can still see there's a huge gap between Vanguard and Robinhood, right? So even if you account for this 45-cent fee differential in these auctions, there's clearly a huge other competition issue that's making these auctions non-competitive. And the most likely one is probably starting price is indicative of whether or not the trade is informed or not, right? So not just retail trades can go in price improvement auctions. Any trade any trader's trade can go through a price improvement auction. Hedge funds, etc., can go through this. So a low starting price might be an indication it's a hedge fund trade, and people are confusing hedge fund trades with Robinhood trades with the low starting price, and that's why people aren't bidding in the auction. So again, these auctions don't look particularly competitive. All right, a couple other just notes here as I go. Any questions? I'm kind of just rolling through because people are raising their hands. All right. All right. My students tell me they watch my videos at like 0.5 speed. So I just might stop and make sure we're okay. All right. So a couple other just things to note, and then I'll spend the last maybe 5 minutes talking about IBKR, because IBKR is really actually pretty unique in how they do things relative to wholesalers. All right, so there's some other research. There's another research paper that says essentially, let's say Citadel gets an NVIDIA trade. All right, so these are the 17 options exchanges that exists. All right, so you can see here in 4 of them, which we're going to call category 1, Citadel is the DMM. So they're the specialist, right? So Citadel, the wholesaler, could route their trade to Philadelphia as an AutoX trade, and then execute their own market maker could execute it because they're the specialists. Then you have a second category, which is you have basically 4 unaffiliated DMMs that do receive some order flow. All right, and then basically you have category 3, which is people, there's either no DMM, so there's some maker taker exchanges, or they don't get any retail order flow. All right, and so there's a hypothesis that, well, Citadel is basically taking these trades and routing them themselves and then giving worse pricing than if they couldn't route to themselves, right? So in other words, if Citadel routed to, say, to Sigma would give you better pricing than if Citadel routed to itself. All right. All right, so what we're going to do is a little experiment. I should also note that DMM assignments are random, so it's a kind of an exogenous experiment, right? So let's take NVIDIA. There's 3 wholesalers if the broker routes to that have the ability to route to themselves, all right? And then there's 2 other wholesalers, Wolverine and Dash, where if they get the trade, they can't route to themselves. They're not the specialist anywhere, all right? And so we're going to use this design to ask 2 questions. So question number 1, is Citadel more likely to route to itself than not route to itself? In other words, is it going to take the advantage of the fact that it's the DMM on NVIDIA, right? And the answer to that is yes, right? So what we find is Citadel is going to route to itself 23% of the time, more than if just randomly were routing trades across these exchanges. And it's really concentrated in AutoX, right? So these are the trades where they have the advantage of being the DMM. Remember, auction trade, the DMM doesn't matter. And so they're 67% more likely to route the trade to themselves if it's an auto-exec trade, right? Because again, their DMM can internalize the trade. The second question we're going to ask ourselves is whether or not there's impact on pricing, right? So if the broker sends our trade to one of these 3 that can route to themselves, or if it sends the trade to one of the 2 that can't route to themselves that are pricing different, and you don't get much smaller difference than 0.0%. So in other words, it really doesn't matter if the broker routes to the wholesaler can route to themselves or not. We get the same pricing. All right. So the last thing I'm going to just show is IBKR. So again, this is the main part of the paper. The IBKR stuff isn't in there. We just started doing that. So again, price execution varies across brokers. It was unexpected to us. I actually thought we'd get the same execution across brokers when we started, given the trades are anonymous. All right, wholesalers are able to price discriminate through the execution method that they pick, as well as pricing within execution method. PFOF appears to be the main driver. And it really calls into questions the effectiveness of the auction market design and probably brings some debate about PFOF. All right, so before I use the last couple of minutes just to show you what IBKR does, are there any questions? All right, well, I know this is probably atypical option type paper for you, so I hope you guys found it kind of interesting anyway. But so let me show you what IBKR does. So first of all, if you put an IBKR into our broker mix, you can see they're kind of middle of the road, right? So they actually have price improvement very close to TD and E-Trade. So they get about 19% price improvement or 20% price improvement on their trades. All right, but probably the really interesting thing about IBKR is how they handle your trades. All right, so they send almost 75% of our trades to auction, right? Which makes them look like Vanguard. But when you look at our actual price execution, we look like Robinhood. So if you look at the auction within auctions, you can see we're closer to Robinhood than anybody else, and they get 0 price improvement on their AutoX trades. All right. So what are they doing? What are they doing different than the wholesalers? All right, and this is what they're doing different. So this is the percent of our trades within each spread bucket that are sent to auction, right? So you can see that 1 cent trades are sent less often than other trades, right? 1 cent trades are sent less often because if you use a price improvement auction for a 1 cent trade, you have to guarantee 100% price improvement, right? So you can't send a 1 cent trade with no price improvement. You have to guarantee 100% price improvement. So what does IBKR do? They said no trades that are 1 cent for price improvement auction because they don't want to guarantee any price improvement. And then essentially every other trade we submit, they send to auction. So they are essentially sending every 2 cent spread higher trade to auction versus you can see here, it's more balanced across the different groups, right? So it's not 100%, it's kind of more balanced across groups. All right. And so what happens is that the end result, and I'm just going to show you what the end result is. The end result is that client experience at a broker that uses wholesalers is very consistent for all clients. So if you look at across spread bins, if you look at our overall average price improvement, you can see across spread bins, it's pretty even across all of our brokers, right? If you're a client and you trade 1 cent spreads only, if you trade 20 cent spreads only, you can see that on average, you get the same percent of price improvement across spreads. You can say in IBKR, your experience will be very different depending on which client you are, right? So if you're trading SPY options only with 1 cent spreads at IBKR, you get no price improvement. If you're trading illiquid like BX options on IBKR, you're basically trading almost at midpoint. So it's really interesting to see that IBKR, again, they're routing their own trades, that they're routing things in a way that really does create a very differential client experience depending on exactly what you're trading relative to what the wholesalers are doing. I'm not saying one is better than the other. It's just obviously they're handling trades much differently. And again, they have much different types of clients than these wholesalers. But it was kind of interesting afterwards to see what they're doing. All right. So with that, it's 1:30, right on schedule. I'm going to give myself fireworks for finishing on schedule. All right. My kids love this stuff. Otherwise, I turn it off, right? You do FaceTime with a 2-year-old. There's nothing better than